Those governments around the world are spending trillions of dollars to keep their households and businesses afloat while they battle coronavirus. When it's all over, they'll be sitting on piles of debt not seen since the end of the Second World War. It's the cover story of this week's Economist, saying after the disease, the debt. Joining me now with more is Henry Curr, who sounds like he'd be the economics editor at The Economist, and in fact he is. Henry, thanks so much for being here. And I put this in perspective for us because this, to me, is kind of the trickiest part of fighting coronavirus. It's, you know, the debt piles up, and what do you do to service it going forward?
Well, the first thing to say is that there's not really any disagreement among economists that massive fiscal stimulus right now is what's needed, massive emergency spending. That's pretty much almost a textbook example of when fiscal stimulus is needed, the pandemic, I mean. The question, I think, is what happens 10 or 15 years out when debt is 30% of GDP higher, and then rich countries around the world start running up against gruesome long-term fiscal forecasts owing to aging. And that's going to be a lot harder unless interest rates stay very low. Now, I saw you were discussing not long ago how America just issued 5-year debt at its lowest ever level. So for some people, it's quite strange to talk about the risks around interest rates. But I think when you're talking about debt that after World War II took a very long time to pay off, it's worth thinking about those issues.
But I wonder, Henry, if the takeaway isn't to say, yes, it's going to take a very long time to pay off, and we've done it once, and we'll do it again. And the real risk of this debt is obviously if we get inflation. And there probably will be some inflationary pressure in the economy from certain supply chain things in certain parts of the labor market. But overall, this is probably a deflationary event. And if anything, that government spending steps up to offset the loss of business spending and maybe kind of keep the economy growing. But that's what the key comes down to, right, is whether we have any real inflation or not.
Yes, that's absolutely the question. And I agree with you that in the near term, it's certain that this is deflationary shock. It's amazing that we've had the degree of hit to supply that we've had, whole swathes of the economy going down, and yet inflation expectations in markets have fallen. But again, the question is, how able are we to forecast what inflation could be in the medium term? And that's the timeline at which you have to look at these things. You have to look at where interest rates are going to be over a long horizon. At the moment, we're sort of betting collectively on the idea that we'll stay in this low interest rate, low inflation world for a long time, in which case, hopefully, with a bit of growth, we can grow our way out of debt. But I think it's fair to say that's not a lock. There are risks around those interest rate forecasts. I mean, yes, rates are very low, but if you looked in past decades at how well the long rates in the bond market predicted recent downward trends in rates, I think you'd say they'd missed it. So I think we're in an economic situation at the moment where we don't know what things are going to look like by Christmas. So to say you can say with confidence that this low rate world is going to be around for the kind of time scale over which countries have to shrink debts that are this large, I think it's very bold forecast to say that we know that for sure.
Henry, I used to take pity on Japan in their economic experience, and now I'm relieved for their example, because if it weren't for Japan, we probably would think there was no way we could have this kind of debt and have an economy growing, have GDP per capita growing, not have interest rates explode. But that example is sitting right in front of us with some similar characteristics. I think it's important to say whether it's possible that the situation will remedy itself, because if not, I go to the end of your piece where you, and it's emblematic. I mean, there are others who are going to be more worried about this and say there's kind of important steps that would be taken to raise revenue, taxes on land, inheritance, carbon emissions, and consumption, of VAT tax in America, trimming spending on the elderly. I mean, all of these policy prescriptions are actually really significant moves that there's a lot of resistance against. And if we don't need to do them, why do them?
So you're absolutely right with Japan, and the evidence from Japan is that much higher public debt is sustainable in a low inflation world. That said, that low rate, low inflation world means that you also do not grow your way out of debt. So Japan hasn't had anything approaching a crisis, quite the opposite, but it hasn't grown its way out of debt either. So the question is, once you break out of a deflationary event such as this, how vulnerable are you then to some sort of unexpected rise in interest rates? How vulnerable are you to further fiscal pressures, another pandemic, and so on? And I don't need to tell you that the long-run fiscal pressures on the rich world are quite acute. So it's not the case that I think any economist or the Economist magazine would argue right now that the priority is balancing the books. Absolutely not. But I think it's worth asking further down the line, when these pressures from an aging society come to bear and debt to GDP ratios are higher, at some point, will governments have to choose between higher inflation, which is basically how it was done after World War II, and higher taxes? And that could be a choice that's coming. Admittedly, it's off the path of bond market forecasts right now, but I think it's far from impossible.
Sure. No, and they're not perfect forecasters either. And I suspect we're going to have that discussion a lot sooner even than you suggest.